So today we're going to talk about how buying power reduction, BPR, reflects option trading risk. Now, the simplest way to define this, option buying power basically is your risk, right?
Thank you. This segment is now over, sponsored by the CBOE.
We're all done. You take your option buying power, and that is the cleanest definition of risk that there is. Because what could be more accurate than what you're required to put up to make the trade?
Yes, exactly. I
Think
agree
about
with
it
you
from
100%.
our side. How much risk do you think we're willing to take to make 50 cents?
Right.
Basically, whatever
That's
the risk,
the model.
That's the model. So BPR, buying power reduction, refers to the capital requirement that a trade must maintain when holding certain positions in their brokerage account. Naked option strategies may require higher capital or more buying power to cover the potential losses in case the trade moves against you. It's essential to fully understand the risk associated with trading options, and BPR is a good measure of helping you to maintain sufficient capital. We threw it up on the screen, the BPR formula for naked options. And again, it's usually less than 20%, but 20% is the number that we go with. The underlying price plays the most important role in calculating BPR, followed by the out-of-the-money value, followed by the option premium. In this case, it's 20% of the underlying price, minus the out-of-the-money value plus the option premium. It usually comes in somewhere between 15 and 17% on naked option strategies. There's a couple different ways to get to a minimum number, but that's how it works. The rule of thumb that we use is about 20%, but it's always less than that. The study, we used SPY data. We looked at naked positions in the SPY. We looked at naked short puts, naked short calls. We recorded the effect of the underlying price, the out-of-the-money value, the option premium on BPR with each strategy. And we used this information that we learned above to figure out the BPR requirements for different strangles. Now, remember, at Tasty, you're allowed to use any strategy regardless of account type, even in an IRA and stuff like that. The difference is in an IRA, everything has to be cash secured. There's no borrowing money. And so everything has to be cash secured. And for the firm, because you never borrow money to trade options, you just have to have enough money to cover the risk. So we make it essentially the synthetic cash secured. All that means is you never borrow money ever to trade options or futures. You only borrow money potentially to trade stock. If you don't trade stock, you're never ever going to borrow any money. The difference is you have to put up a certain amount of money to cover the risk on your option trades. That's BPR. And in an IRA account, you have to put up pretty much the cash secured risk.
Yeah, a lot of people will mistake it. Like they'll say, how much is the margin for that trade? And even, I'll say it sometimes, instead of saying buying value, what's that?
Yeah,
it's not margin, right?
It's not margin. There's no borrowing. Let's go to the next slide. So this slide, we looked at naked short puts, and we looked at 16 delta, the 50 delta, which is at the money. So we looked at out of the money, at the money, and then in the money short puts. And you can see the difference is pretty small between doing an out of the money and an at the money and an in the money. It's not that dramatic a difference. You go from 10,900 to 11,400. And the reason it's so expensive right now in the SPY is only because the SPY is so expensive.
Right.
That's it. And let's see what the team wrote here. Yeah, underlying price plays a majority of the role in buying power. Out of the money value only comes into play for out of the money options. And the 50 and 70 delta puts don't have any out of the money value. So that's why they're virtually the same. Let's go to the next slide. The point for this slide was just showing you that it doesn't make much of a difference whether it's in the money or out of the money. So when we do out of the money calls, we do naked calls in the SPY, it's going to be very close to the same thing. A 16 delta call, 10,900, just like it was for the put. And the in the money's 11,400. At the money's 11,400, in the money's 11,400, same exact thing. There's no difference basically for a put and call. So you sell them both, you only have to put up the same amount of money, but you get double the premium. That's why we do strangles instead, because you don't know which way the market's going to go anyway. Here's the 16 delta strangle. And since we don't sell, at the money straddles very often, we're not going to sell in the money strangle or straddle. So we're going to look at the 16 delta strangle. On the buying power, you can see on the put side, on the call side, and on the strangle side, they're all the same. So when people go, why do you sell both? Here, that's the reason. Because you get twice the premium for the same amount of money. The buying power for a strangle is based on the side that has the higher buying power. Since you can't be margin on both sides, both positions can't be out of the money. So you pay just that one amount. For the same delta on put and call options, the call strike is much closer to the stock price compared to put, but regardless, the number comes out to be the same. Sometimes there's a little bit higher number on the call side than the put side if there's call skew, but in this particular product, there's not. I think that there's nothing on these slides, Pat, that would surprise anybody, but just the sheer number here of just being $10,000, $11,000 to sell a Strangle in the SPY just is a lot.
Yes,
that's all it is. That's the challenging part.
Yep.
You know, it used to be 5,000. Now it's 10,000, 11,000. And it's just based on price.
As the price got bigger, the buying power got bigger.
So the buying power reduction is an important metric to measure risk on a trade. It is the risk. Essentially, that's how we look at it. It is the risk. The underlying price plays the largest role in buying power, and then comes other things like out of the money value and everything else. But the difference between in the money, at the money, out of the money, it's all going to be very close to being the same thing. In Strangles, the same delta put and call options, more money should be allocated towards adjusting the call side and losing position because it's more likely to get hurt on the call side. And the only reason they're saying that is because more things go up than down. You know?
Well, it has in the last 20 years. Yes, for sure.
But the point of the discussion today is just so you understand that first of all, you can't borrow money to trade derivatives, options or futures options, only stocks. B, so there is no margin. But you need a margin account to trade it. Those are regulatory rules. Buying power reduction reflects your risk very accurately, and put and call are going to be basically the same as the Strangle.